Hi everyone, this is a technical analysis on EURUSD. Let's start with some fundamental background first. In the US, the Fed left interest rates unchanged as expected at the last meeting. The macroeconomic projections were revised higher as the economy showed a much stronger resilience than expected, and the dot plot showed that the majority of members still expects another rate hike by the end of the year, with less rate cuts in 2024. Fed Chair Powell reaffirmed their data dependency, but added that they will proceed carefully. The latest US core PCE came in line with expectations, with its inflation continuing steady. The labor market remains fairly solid, as seen last week with another strong beat in jobless claims and the NFP report. The SM manufacturing PMI beat expectations, while the SM services PMI came in line with forecasts in another sign that the US economy remains resilient. The US PPI data yesterday surprised to the upside, but it was mainly energy driven, and the market brushed it aside. The Fed members continue to cite elevated long term yields as a reason to proceed carefully and pause in November as well. The market doesn't expect the Fed to hike anymore. In the Eurozone, the ECB hiked by 25 bps at the last meeting and added a line in the statement that hinted to the end of the tightening cycle. President Lagarde didn't push back against the idea of them having reached already the terminal rate and highlighted the slowdown in Eurozone economy. The Eurozone CPI recently missed across the board, supporting the ECB stance. The labor market remains very tight, with the unemployment rate hovering at record low levels. Overall, the economic data lately has been showing signs of fast deterioration in the economy. Most ECB members are leaning towards keeping rates higher for longer now, and the market doesn't expect the ECB to hike anymore. Now, on the daily chart, we can see that Euro USD pair has now reached a key resistance level where we have the confluence of the trend line and the 38.2% Fibonacci retracement level. This is where we can expect the sellers to step in with more conviction and a better risk reward setup to position for another sell off into the new lows. The buyers, on the other hand, will want to see the price breaking higher to invalidate the bearish setup and reverse the downtrend. On the 4-hour chart, we can see that divergence with the MACD right around the key 105 support signal the loss of the bearish momentum and the bounce back into the highs. The trend on this time frame is clearly bullish as the price continues to print higher highs and higher lows, with the moving averages being crossed to the upside. More conservative sellers might want to wait for the price to break this counter trend line around the 105.90 level before joining an eventual sell off. On the 1-hour chart, we can see that we have another divergence with the MACD right at the key resistance level. The price action has also formed what looks like a rising wedge, which is a reversal pattern and increases the odds of a sell-off from the current levels. Failed patterns are also significant, if not more significant, so if we see a strong rally from here, it could signal that the trend has turned around. The economic data, in fact, today will be crucial for the next direction. Today we will get the most important report of the week, that is the US CPI report. The market is likely to focus on the core measures, and if the figures surprise to the upside, the US dollar is likely to appreciate, as the Fed might raise rates again in November, and the 2024 rate cuts could be repriced again. If the data surprises to the downside, though, we could see the US dollar weakening, as the market could bring rate cuts forward, and the falling treasury yields will weigh on the greenback. At the same time, we will also see the latest US jobless claims data, which is an important labor market report. The US dollar is likely to appreciate, both in case the data is much stronger than expected due to a more hawkish pricing, and much weaker than expected figures as the risk sentiment might deteriorate due to recession fears. Tomorrow we conclude the week with the University of Michigan Consumer Sentiment Report.